Hi, Greg Weldon here with another episode of Money, Markets, and New Age Investing. And today, I'm not even sure what I'm going to call today's episode yet. I haven't come up with the title. There's a couple that I could use that we're going to discuss in terms of the macro themes. Front and center right now is the whole debt ceiling issue in Washington, which to my mind is perhaps the single most stupid thing that comes up that becomes this major news story. Like the U.S. is going to default on their debt. All right. It's just hysterical because this comes up. It's this big deal. And eventually the parties have to agree because there's no choice. Do people even understand what this actually tells us? What this actually means? Do we get the fact that the government every so often, every 2 years or so, has to raise the debt ceiling, which means we have to increase the amount the government's allowed to borrow because the government cannot exist without perpetually borrowing more money. The government is essentially bankrupt. The government is essentially insolvent. And without being able to perpetually borrow trillions and trillions of dollars more money, the government would cease to operate. Broke. Do we get that? I mean, and of course now the politicians that be want to spend on this and want to spend on that and, you know, all the giveaways and so on and so forth. I mean, it's really interesting because this is all comes from public borrowing. This is debt incurred by all of us. All of us. And this is the show in Washington. It's a laughing stock. The U.S. has become a laughingstock. The two-party system was our strength, and it's now our downfall. It's, you know, you are completely divided. And it's either this narrative or this narrative, and there's no middle ground. All these issues, from abortion to professional golf, that divide us, there's no middle ground. There's no discussion of rational answers to the questions that be put before us. And when it comes to debt, we chose this path a long time ago. Whether it was 1971, Nixon closed the gold window, didn't want to pay back France with our gold to fund the Vietnam War, so on and so forth. I mean, it's been a 50-year credit bubble. And the last time you could have reversed this organically and had organic growth and had sustainable growth was 1990. When Alan Greenspan took the Fed funds rate to 3, when inflation was at 3, first real zero interest rates in the fact that, inflation and the interest rate were the same, zero interest rate on a real basis, and people went berserk, like how this is going to cause inflation. Well, now you have inflation. The genie is out of the bottle. You're not going to be able to turn this around. But what's interesting about it is it's the same playbook. Borrow more money. The Fed will ultimately monetize that debt by printing more dollars in cahoots with the Treasury. It's a foregone conclusion. And this is why everything has changed. And when we talk about the new era, the age, of polarization, we see it in so many ways. But this is straightforward. The U.S. government is broke and without perpetually borrowing more money would cease to operate. So when we turn to the Federal Reserve, and in this whole context, what does this mean for the Fed? Well, it doesn't really mean anything for the Fed. I mean, the Fed is already on their own campaign to basically bring the labor market down. They've told us this. Powell, again, I say this every episode. Powell has told us in 2018 what he was going to do. 11 white papers, over 300 pages, the new policy paradigm. I could talk about this till I'm blue in the face. I read every single page. Everything they said they were going to do, they've done. Every single thing. And in the context of, again, the Volcker playbook here, it is pain, economic pain. And Powell has said this, we need to see declining employment, rising unemployment. We have rising layoffs. February was a record for the month of February dating back to 2009 in terms of the layoffs. So we have the pain there to some degree. But the question becomes, how much pain does the Fed really want to inflict here? All right. And I just did a piece where I asked the question, is Jerome Powell the reincarnation of Charles Henry Sanson? Who the heck is Charles Henry Sanson? Well, he was the executioner that pulled the string on the guillotine during the beheading of King Louis XVI in France in 1793. Probably the most famous beheading. There were a lot of candidates. But I thought Charles Henry Sanson was a good name to equate to Jerome Powell. He wants to pull the guillotine string on the labor market. All right? Bottom line is, when it comes to bank credit, which is a far bigger thing, all right, you have an issue where Jerome Powell is now not Charles Henry Sanson, although he is, potentially going to be still, if he were to, basically chop the head off the credit dynamic where credit becomes really tight. Holy mackerel. Think of the pain then. Think of the pain that would come if you basically cause the credit dynamic to seize. Well, you're part of the way there. And just as of yesterday, Janet Yellen saying, yeah, we got more banks that are probably going to fail. Consolidation is good. And for sure, there's way more banks in the U.S. than anywhere else by a degree of 10, if not 40. It's like 4,000 banks in the U.S. Do we need that many banks? No. So that's number one. But think about the credit contraction angle on this. All right? And what does the Fed say? Well, the Fed comes right out and says, we expect further tightening of credit conditions. What is the comment? Okay, Bowman from Boston said, and I'll quote, I wrote this down so I could quote it. Inflation remains too high. And as senior loan officers signaled beginning last summer, we have already talked about this, the credit has been, the credit conditions have been tightening for a while. Okay. But as senior loan officers signaled beginning last summer, credit has continued to tighten. I expect this trend will continue given increased bank funding costs and reduced levels of liquidity. This is the Boston Fed President Bowman basically telling us that we expect credit conditions to tighten further. All right? Now, what's interesting is the Fed keeps having to talk tough for one case because the market is already pricing and easing. So the Fed just then, I think it was Bowman, at the same time said, there is no way we're cutting rates until the second half of 2024 at the earliest because the market is pricing in rate cuts by the end of this year. The market is pricing in significant rate cuts by the end of next year. At one point, the Fed funds forwards were 3%. They're going to cut 200 to 225 basis points in the next 18 months. All right. Not only that, the dollar peaked in October, went from being up 20% year over year to flat. All right. Gold in dollar terms came off big. In other words, monetary conditions were loosening as the Fed's trying to cause them to tighten and having the effect of potentially pulling the guillotine string on credit because they want to fight this whole narrative that the market has because they can't have that. They can't. I mean, inflation comes roaring back and then again, the Fed has told us, and the Fed has stuck to everything. Powell has stuck to everything he's told us, and he's told us we will not ease too quickly because that would be a bigger mistake than holding off. Make sure inflation is dead. But in so doing, what's the level of pain? Are you going to bring the guillotine down on the entire economy? And what's interesting is in 79, all right, 78 actually, and if you go back to the Volcker playbook, all right, Paul Volcker said, yes, we want to, we are going to see some economic pain, but we don't want to spark a credit contraction. That's exactly what he said. Now, we haven't heard that from this Powell. This is the major difference. It's a nuance, but man, is it huge. They are not saying that here. Why? Because credit's out of control. Credit's out of control. Now, that's almost a catch-22. Are you going to restrict credit when credit's out of control? And that's the only way some people are getting on in terms of paying the bills. All right? The most recent New York Fed household credit survey, which just came out literally this week, you have record levels of debt now on the household level. All right, you are up $3 trillion, $2.9 trillion since 2020, since the pandemic started. That's a 20.5% increase in 3 years. You're going to increase it's basically doubling every 15 years, if not sooner. And at this rate, it's $1 trillion a year, $1 trillion a year added to consumer credit, to household credit. The government's at 1.6 to 2 trillion. $3 trillion a year in new credit. Should the Fed stop that? I mean, should you really, if you really want to make sure inflation doesn't come back, you need everything to deflate, right? Well, that would include the stock market. Can you do this now versus 78, 79, 80, 81? Can you do this now versus 1990? No, you can't. That is the problem, because credit is what's keeping a lot of people alive. All right. In that context, the percentage of growth in household credit is led by far in credit cards. Now, we've talked about this before, but here's another number that shows the amounts. There is a record number of credit card accounts now. The new accounts opened is soaring. What's interesting about this, with about $1 trillion in credit card debt outstanding, the limits on all these new credit cards is, get this, almost $4 trillion. You got about $3 trillion of more credit you could use. The problem is it's at record cost, 21% on accounts that are actually charged interest, 21%. It's the highest cost ever, and we're borrowing the most ever. And we're doing it to pay the bills. The Fed, there was a great speech by James Bullard from the St. Louis Fed this past week, and he had some really cool charts, one of which was savings. You have all these guys that come on the pop media financial television stations, right? And not only do the networks have a vested interest in stocks going up, but every guest is like a stock guy, right? So of course, or works for an investment bank or something along these lines, where everyone has a vested interest seeing the stock market continue to rise. And one of the main things they say is the consumer balance sheet is strong because of the pool of savings created during the pandemic. That pool is gone. It has mostly been depleted, mostly. All right? Tough to get a gauge on it. But the degree to which you can look at the numbers, the Fed themselves came out. Bullard used the same chart that I kind of been using. When you look at the monthly numbers annualized, you've gone from having a pool of savings around $3 trillion to basically having less savings now than you did before the pandemic. I've said that before, and now Bullard, with a great chart, shows the same exact thing. Savings are gone. Your paycheck buys you less the second you get it to the bank. Borrowing on credit card debt at the highest cost ever to pay the bills. So can this just continue though, right? I mean, hey, it's credit in perpetuity, right? Well, no, because all of a sudden delinquencies are going up, and it's the transitioning into delinquent, and it's the serious delinquencies, and they're about to break out through the pandemic highs and reach the highest level since 2007, 8, and 9. Now, it's still a long way from there, nominally speaking, but you've had forbearance that's held it down, and you're seeing big increases especially in credit cards. The delinquencies, the serious delinquent, and guess what else? Back-to-back months of over 100,000 bankruptcy filings. Haven't seen that since 2009. Check that, since the pandemic, 2009, before that. So what are we seeing? Are they going to bring the guillotine down on the consumer? I mean, it's already happening. All right. The guillotine, they're playing games with the consumer. The guillotine's kind of cut the neck, but hasn't sliced the spinal column yet. All right. When you talk about retail sales have been strong. They've been double-digit year-over-year gains. I've been warning on this for a while. Once the base effect wears off, you're going to see a whole different picture in retail sales, and that's exactly what is happening now. This retail sales report from this past week was a disaster, an absolute disaster. The 12-month net change in monthly spending is down to $3 billion. That's nothing. The only other time it was this low besides the pandemic, and most recently, was in December of 2018, when the economy was rolling over and the Fed was getting ready to cut interest rates. I mean, this is not a good number. Not only that, worse than that is all the discretionary items, and I mean all of them except eating and drinking establishments and online shopping, which both growth has slowed dramatically in both. Still growth, though. That's the one place where you have growth. But other than that, it's bloodbath, all right? In terms of the rolling 12-month change, which measures the difference in the monthly spending, is in negative territory to recessionary levels in clothing, furniture, appliances, electronics, building materials, garden supplies, department stores, sporting goods, books, music, hobby stores. All of them, and vehicles as well. But vehicles, the only one out of all of these that haven't had back-to-back monthly declines and back-to-back months in negative territory on a rolling 12-month basis. The levels are disturbing. When you look at building material and garden supply stores, aka Lowe's and Home Depot, which is why they're lagging the market right now, by the way, you had virtually no downturn, of course, in the pandemic because everyone was building up their homes because you got to stay home, you're going to be quarantined, you're going to fix up your house, right, to make it more comfortable. You certainly had that dynamic big in 2007 as a precursor to what happened in 2008. And in the last 12 months, spending on a monthly basis is down $1.6 billion. It is the second deepest ever, behind only 2007 through 2009. Organically, on this dynamic, this to me is one of the biggest tells out there, is that this sector has now rolled over and is deeply negative. Vehicles as well, deeply negative on the 12-month change. Vehicle, it's everything. All right. This really, this is the third worst that we've seen in the last 30 years. Pandemic, 2008 and 9, and now. Is this the guillotine coming down? It is. Now let's look at inflation, because inflation has come down just like I said it would. I said it would have a four handle when that was not popular opinion. And that's exactly what it has done. This wasn't a tough call. I'm not patting myself on the back too hard because it was an easy call. From here, things get much more tricky because the year-over-year base effect will roll out at the end of June, meaning July numbers. And from then on, it could go any which way. And it'll be largely the monthly increases, which is what we've seen in a lot of places. In the U.S., food price inflation is still high. Food at home above 6 has always been a recession. Food at home has been above 6 for 2 years running. It has gone up to 13.5 at the high and is now all the way down to 7.1. I broke down the components, which I do every month. 60% of the food components out of the 108, I believe it was, 7% or higher. 40% are in double digits. 40% of the food items people buy are still inflating at double-digit rate. And this is every month, year over year, every month, year over year, higher. Only 15% are in deflation. In the meantime, shelter's still 8.8, 2 months in a row. And services ex energy is now above 7. This inflation has become a little more embedded, too. And the degree to which some food will come down, some food will not. Crop report, by the way, this week also, actually last Friday, was a horror show for soybeans and corn and some of the other grains. It really was, which is good for the inflation picture. On the other hand, it still sets up a bigger picture next year. It's going to be bullish again. So it's a big bearish trade and then a big bullish trade. But interesting to note, some pressure off of food in some of the commodity dynamic in the sense of the crop report that was just released, which was really bearish for prices, good for the crops. But this is a war between the markets and the Fed, because the markets are saying the Fed knows the damage they're doing. They're going to stop doing it, and then they're going to be forced to reverse, and that could very well happen. What's left open is the stock market. It's really the only thing, kind of with gold, that hasn't deflated. And when you have the dollar down from its peak so much, all right, when you have the forward Fed funds pricing in 200 basis points of rate cuts, right? When you got gold at 2,000, when you have the stock market refusing to crack, guess what? The Fed is not going to want to move. The Fed is not going to want to satiate that desire for the markets to be right here. And the markets have always been right, and the markets will force the issue. But does that mean the stock market has to crack wide open? I think that's one of the things the Fed's waiting for. I think the Fed would, that's why the rhetoric remains really hawkish. All right. So in terms of all this delinquencies and all the stuff you have going on here on the consumer side, that's interesting as well, too. But when we start to look at this globally, it gets even more interesting. And especially in a place like Japan, where the central bank has done nothing. All right. Core CPI in Japan this week reported 4.1%. rising, up from 0.8 a year ago. It's risen almost every month the last 12 months. I think there was 1 month where it was unchanged. But it's gone from below 1 to above 4. And it's the highest when rising since 1981. Highest overall since 1982. It's a 3-decade high. Check that, a 4-decade high. It's a 40-plus year high. All right. Back in 1982, when CPI, core CPI in Japan was 4%, the official policy rate was 9%. 9%. Then they cut it to 7.5, 150 in 82, and then they lopped off another 100 right away. So they cut it real fast. But it was 9% versus now it's still minus 0.1. It hasn't moved. So the real policy rate in Japan is the deepest negative number it's ever been. It's the most stimulative ever. They continue with QE. The new governor who just came in to replace Kuroda basically said, I'm going to be patient. And I did a piece on this recently. I called it the patience of Job. If you know the Bible, and I'm not a big Bible guy, but Job was the guy who has shown the most patience ever, something that I kind of lack sometimes and have learned to, acquire over the years. But the degree to which this guy's going to let the fires burn and continue to pour gasoline on the fire, Nikkei breaking out to a 40-year high, the yen breaking down, gold and yen at new highs. So these are places we got to play. We start talking about Europe. All right, inflation just went back, and I did another piece here. There's been a Godot sighting. You remember, Godot is inflation, and Godot never showed up. I was waiting for Godot for years when Yellen was Fed chair. And then changed the narrative in late 2020, early 2021 when I did Godot, the alternative ending, where Godot shows up and Godot is inflation. And then you can't get the guy to leave. Recently, I said Godot has left the building. But the caveat is I don't really think he's left the building. I think he's hiding in the curtains, about to pounce back on stage and shock everybody. Well, that's kind of what happened. There's been a Godot sighting in Europe. Italy, Spain, Austria, 3 totally different countries. Low, high inflation, both. Austria always low, now high, 9%. Spain dumped to 3.3 and got back up to 4.1. And Italy back above 8 now. It's been there like 12 months in a row. Food inflation coming down, but still double digits in all 3 places. All right. And all of a sudden, it's like, there's a Godot sighting in Europe while the ECB is still at 3.75. So these other central banks have more to do. And that's going to also help push the dollar down, which could actually help the U.S. stock market and help gold. And it works against the Fed's narrative. So this is an amazing war going on. I think you need to be somewhat exposed to some degree overseas as well. Right now, the Nikkei looks really good. I mean, it just does. There's no way around the technicals on the Nikkei on a long-term basis when it's reaching the highest level since the 1990 bubble. All right. At the same time, you have still ZERP, you have still QE, full-blown QE. The balance sheet is expanding again, just like, you had a little bit of a dip. They kind of backed off a little bit with that into the end of Kuroda's term, but now it's full bore back on. And at the same time, you have the yen depreciating pretty rapidly. That's a great setup for the stock market. The Nikkei loves it. EWJ is the ETF to trade this. Now, with the ETFs, okay, I'm going to offer you a link to a video and a PDF with all the charts in that video on the stock market right now in the US and, playing it with the ETFs, portfolio building, these kinds of things. I've been saying that I want to, help people better understand how to do some of these things and then how I look at it. And of course, down the road, hopefully, have this as a business and we can have customers and so on and so forth. But at this point in time, it really is to give you some guidance and to help you to maybe understand where you can do this yourself. And if not, then we're willing to help you down the road. We kind of, turn this into, it's a product we've been developing for a long time in cahoots with one of the brokerage houses that's interested in licensing it. So it's something that we're going to, ultimately bring to you. But as a forerunner of that, okay, when we talk about what are we doing now? I mean, what's amazing here is the U.S. stocks, I think that's part of what the Fed wants to derail. I think that's going to be really interesting. You have a major war going on here. The Fed wants to disappoint the expectations for Fed easing by the end of this year, and they don't mind. The stock market has some pain. They just don't. This is the guillotine guy right now. All right, he doesn't care. He's going to let credit go. He's going to let the consumer roll over. He's going to let the economy go. He wants unemployment to be rising. He wants it to be like the early 80s when Reagan was elected, when people were carrying signs, I need a job. I can't pay the bills. Right? Right now, U.S. stocks, and I did quantitative work. I'm a math and science geek at heart, as you probably know, if you know me at all. And I wrote algorithms back in the 80s that I've used my entire career I don't go purely quant. I believe in everything has to mesh and meld. The macro story has to mesh and meld. The technicals have to mesh and meld, and the psychological angles have to mesh and meld, and then the math and the technicals are the execution of the way we go about, actually trading, if not, creating portfolios. For me, portfolios are always what they call active. There's a word for it. Dynamic. All right, meaning they change. I mean, I'm not going to say here's our portfolio for the quarter. I can't do that because we track the NASDAQ, we track the Japan, we track the UK, we track Australia, we track Canada. But really, we're focusing right now on the S&P 500 because you have all the sectors, you have sector indexes, you have all the ETFs, and you have all the individual stocks. So you can use the ETFs, you can use the stocks, and then, allocate based on what are the trends. I want bullish trends. I want to be long the things that are in bull trends. It's that simple. It's not based on performance. It's based on the strength of the trend using the quantitative analysis that I have. We call it the trend tracker is the kind of the tool per se. And we're resurrecting for this purposes, the ETF playbook. That would be part of the Wealth and Life service. So in that context right now, there are 27% of the S&P 500 stocks are trending bullishly, 28% are trending bearishly. Neutral is 45. This is about as neutral as it gets. This is about as polarized as it gets. And while the government's talking about, debt ceilings and, all this other, tomfoolery and buffoonery, you have the dynamic here where infotech now is resurrected. All right. In this little 10-minute video, it's going to be a bunch of charts and it's going to be a bunch of, quantitative numbers. I'm going to show you, this is how much we want in infotech. This is how much we want in industrials and healthcare. All right. Do we want to be involved in Japan? Yes, we do. Do we want to be involved in some of the commodities? Yes, we do. And then the context of if customers want to break this down into the equities, we're going to show you the ones that have the biggest bullish trends. In healthcare, it's Eli Lilly. I mean, straight up. You look at like the consumer, some of the consumer stocks are really in good shape. McDonald's, Marriott, all the home builders. All right, really doing well. In terms of big tech, NVIDIA is just a rock star. But what's interesting here is Amazon and Meta have both had big declines and set up really well here, technically speaking, to add to the equation. So we're going to break all that down for you. I'm going to explain some of the terminology around the quantitative tools, show you how the different ways someone can create a portfolio, what my kind of recommended ETF portfolio is, including stuff like, the EWJ, where we want to be long the Japanese Nikkei, all right? But we also want to be long gold, all right? So the GLD, we also want to be long sugar and the CANE. Also want to be playing in the bond market, SHY. So from that perspective, email me at sales@weldononline.com. Sales, SALES, at weldononline, WELDON, online, all one word, weldononline.com. And I will get you the PDF with these charts, which I actually created this morning, especially for this. And so they're all updated, fresh and everything. And then the video explaining kind of how we go about, selecting these things and how do we enter them into a portfolio and just maybe some tips that might help you create your own portfolios. And then, we'll see how that all works out in the next episode coming up, whenever that might be. I still don't know what I'm going to call today's episode. You'll find out when we publish it. But thanks for listening. Greg Weldon with Money, Markets, and New Age Investing.